That's the closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the market moves to get you up to speed on the action from today's trade. Robinhood CIO Steph Guild, as well as Yahoo Finance's Jared Blickery, join us here to break down the moves. And Jared, let's start with you on the close. We have a record for the S&P 500 closing above 6,400 for the first time ever.
Yes, we do, and we'll start with the Dow, though. No record for the Dow. Let's just take a look at that, up 483 points, or 1.1% right there. NASDAQ Composite, we do have a record there, up 1.38%, above 21,600, and the S&P 500 crossing, as you said, 6,400 for the first time. That is good for 72 points, or 1.14%. We'll also take a look at the small cap S&P 600 index. Look at that, 3.23%. That is the best return in at least 3 months. Might have to go back a little farther. I'll check the books afterwards. But just kind of scrolling down here, we already took a look at the bond market, but I will give a final look at the 30-year, 4.88%, up 4 basis points after that CPI report. There was an initial dip down, which was interesting. But here's the sector action in stocks. Communication services, that is a record high, up 1.9%. We're going to take a look at some of those components in the NASDAQ 100 just a little bit. Tech, also a record high, 1.55%. From there, we also have materials, XLB, and then XLF is financials. Both of those outperforming, but no records down the score for any of these other sectors. But even real estate, up 17 basis points in the green today. And if we take a look at the scoreboard on the NASDAQ 100, we can see some outliers here. Meta up 3.15%, Broadcom up to, almost 3%, we'll call that. Microsoft, Apple, and Alphabet each up more than 1%. And we'll dive into the semiconductor industry, where we see a lot of dark green here. Lam Research and Micron and Qualcomm each up over 3%. Texas Instruments up 5%. And let's check out software, which was lagging yesterday. Big standout there is SAP. That's down 4%. But for the most part, we're looking at some green and dark green. Palo Alto Networks up 4%, CrowdStrike up 2%, and then Take-Two up 4%. I'm going to take a look at the Dow here, and we do see a little bit of red. IBM down another 0.75%. It's been trending down the last month. McDonald's also taking a little bit of a dive for almost 1%. But for the most part, we have more green than red, and United Health and Goldman Sachs each up more than 3%. I think that's a record for Goldman Sachs. Let's check out the year to date. I believe that is up almost 30% on the year for Goldman Sachs. And then finally, I will close on the transports, which had been lagging, but not today. And we see Delta Airlines up 9% in the upper right. Southwest Airlines up over 5%. United Airlines up over 10%. So really some outstanding results from the airlines today. And I'll send it back to you on those.
All right, Jared, thank you so much for that breakdown. And Stephanie, you have a 6,200 price target for the S&P. We just have this new record. What's contributing to your cautious stance?
So I started the year actually at 6,500, and then I moved it down when the tariffs happened, right, to 6,200.
You always go with your first gut.
I know. Well, I've maintained the 6,500 upside potential because I just really wanted to see what happened with tariffs and what happened with its impact on growth and inflation. And I think we're starting to see the better side of it, but we don't know for sure. And I also am thinking that there could be some sort of like blip sometime in September, which is why I've been sort of keeping at the 6,200 mark. But really I feel like I never left 6,500. It's just
that's where your heart is.
Yeah.
Well, one reason that we've seen a lot more conviction in higher S&P targets across the board, Citi, for example, yesterday just hiked their price target to 6,600, has been centered on earnings growth and how not just the earnings that we've seen this past quarter, but really in the out quarters. End of the year, 2026. How are you llooking at earnings, and how does that help fuel some of the optimism?
Yeah, I was thinking, I felt that they were too high at the start of the year, like 14% earnings growth, I think is what was expected at the start, and they'd moved down for the full 12 months, down to 9%, and that felt more reasonable. I still don't think that everything we're going to see from some of the things that have changed from a policy perspective have seen the light in the earnings numbers, and Q3 and 4 are pretty robust in terms of expectations, whereas they weren't for this past quarter. And so that's the one thing I'm sort of like, when you look out, it's double digits over the next 12 months. And I think if you do see some sort of impact from the tariffs, it's probably going to be 1% or so in the GDP. Kind of rule of thumb is 1% GDP hit is 4% earnings growth hit. So I think you could see some pullback in that. And that's why I think September will have this like come to, I don't know what the right word is, but sort of get to the right place. And then I think you can kind of continue to go from there. And a lot of this, I think, comes back to CapEx spending.
So the blip that you're potentially seeing in September,
yeah,
how significant is that going to be, especially relative to where we were in April and the capacity for the index to climb back?
Yeah, I think a normal correction is somewhere in the 8 to 10% mark, and I wouldn't be surprised if you saw that. But it's not. I don't think it'll be there. Like it's very normal, and if you're going to be invested in the U.S. stock market, you kind of have to expect that every 12 months or so.
Yeah, and at the end of the day, no one really knows what's going to happen, so we'll have to continue to track your target and see what comes about. But in the meantime, let's switch gears to oil. A sharp drop in energy prices is driving lower gas prices, and that's helping keep a lid on headline inflation. In July's Consumer Price Index, the gas index fell 2.2% from the prior month, helping pull the overall monthly headline number lower. For more, we're bringing in Rebecca Babbitt, senior energy trader at CIBC Private Wealth. So Rebecca, let's start there. How much of this pullback in gas prices is driven by seasonal trends versus maybe broader shifts in the crude market? And do you expect this relief to last for consumers?
So that's a great question, Allie. And I would say most of this pullback in gasoline prices has not been seasonal. Seasonally, they adjust those numbers in the CPI. This has been much more structural. And the structural change that's taken place for gasoline has really been the drop in crude oil prices. If we look at a year-over-year basis, crude oil is down 15%. Gasoline prices year over year are down around 9%. So basically the inputs or the crude that goes into the refiners to make gasoline has really been under pressure because OPEC has been bringing back a lot of supply over the last 6 months and really compressing crude prices lower, combined with the fact that the economy is in question as we kind of move along this tariff journey and understanding what's happening with demand. So we have this kind of increase in supply coming from crude oil and concerns about demand. So we've had a really big kind of pressure on the commodity price. Refining margins, interestingly, have actually held up really well. Thus, the 9% drop in gasoline versus 15% in crude. And that's actually because we have had product inventories in gasoline really low. Venezuelan products have been off the market. We had wildfires in Canada, which hurt some products. So the product market and the refining margins have been okay. All of that kind of compression in price has come from crude oil itself falling lower.
Interesting. So given all those structural changes, where do you see crude heading towards year end? Are prices skewed to the downside?
So the market is very much in consensus that the risk is to the downside from here. And it kind of plays into everything I kind of touched on. More supply coming from OPEC, more supply coming from non-OPEC. The EIA just released their monthly report and increased the non-OPEC supply for the year from the US, from Brazil. And then you have the OPEC supply as well. And demand, which is expected to kind of taper off here in the second half as tariffs start to bite. So consensus is that we gravitate down to kind of the mid to high 50s in WTI for the end of the year. My view is I actually think that's a little bit too negative and very much kind of telegraphed at this point. So I think we could kind of stay in this, let's call it 60 to 75 range, 60 being kind of that downside, lower end of the risk kind of spectrum, just because I'm looking at positioning, I'm looking at how many CTAs and systematic funds are starting to lean very short. The options market is starting to show you that puts are getting much more expensive than call options, which tells you that people are actively hedging that downside. So a little bit of it is starting to get priced in. So that's kind of, I like this 60 to 75 range. And I think the upside is bound by the fact that we do have a lot of supply that kind of sits on the sidelines in Saudi Arabia, in the UAE, that kind of buffers a potential supply shock. Now, if we lose, Russian barrels, and Friday is obviously a huge event for the oil market in terms of what happens with the Putin-Trump meeting, and if Trump decides to move forward with either sanctions on the shadow fleet or tariffs, that could change the picture pretty dramatically. I think the upside is buffered by that spare capacity.
Yeah, and can you talk a little bit more about some of those global risks with that Trump-Putin meeting, what that means for China and even India that's pulling back some of their oil from Russia?
It's a really, really impactful meeting for China and India. They've been benefiting tremendously since 2022 by buying cheap sanctioned oil from Russia, right? They've had discounts as much as $23 a barrel. Obviously, that was in 2023 to current discounts that they're getting, which is more along the lines of $4 to $5 by buying these sanctioned barrels that the rest of the world is not. So a change here where they might be forced to either pay higher prices for Russian crude or not be allowed to kind of participate in buying Russian crude will have a big impact on their economies. And I think that's another factor the crude market is trying to weigh here. We might lose supply as a result of this, but we might also lose some demand because China and India are really big growth drivers for crude demand. And if we start to kind of see their prices rise and you see the impact on the consumer, it's just not a linear equation. The supply impact, though, if we break down the numbers, India does import right now about 1.7 million barrels of Russian crude every day. That's a big number. The market does not see that entire amount coming offline, even in a pretty extreme scenario where it's sanctions on the shadow fleet or higher tariffs. I think that the consensus is if this doesn't go well on Friday, maybe we lose close to 1 million barrels in India of Russian crude. That would have a pretty big impact on the market, but I think is somewhat manageable. If we start talking about China, that really changes the conversation and it would be really hard on the market. We don't know where that conversation is going, but clearly huge catalysts on the horizon for how crude supply looks going into the end of the year.
Really interesting stuff. Rebecca Babin, thank you so much. Appreciate it.
Thank you.
Well, chips are in focus after a strong year for AI-driven demand, with investors now looking ahead to earnings from Nvidia and watching Intel as it works to regain its competitive footing. Joining us now is John Vinh, equity research analyst at KeyBanc Capital Markets. John, thanks for being here. As we know, the AI story is still front and center, but taking a step back, how should investors be positioning for it right now? And is the upside still mostly in the Mag 7, or are you seeing pockets of opportunity elsewhere?
Yeah, I cover the semiconductor industry, and I think the three names right now in the near to medium term that are best positioned for AI demand is going to be Nvidia, Broadcom, and AMD. Nvidia, obviously, kind of the bellwether. They've got a clear lead on the space. No one's even close to them. They just dominate the space. They're ramping kind of their new server rack platform called GB200. Also called Blackwell. They're also on the verge of also ramping Blackwell Ultra in the back half, and that's only going to further extend their lead. If I think about Broadcom, they are kind of your play on custom AI silicon, more and more hyperscalers like Google with their TPU franchise. That's going to be kind of the key tailwind for them into the back half of the year. And then AMD is kind of your up-and-comer, right? They started at a really small market share position. They're launching their latest AI GPU, the MI355. That's going to drive significant upward estimate revisions in the second half and drive outsized growth for them. So those are my three favorite plays right now heading into earnings.
And how do you view the potential risks ahead? President Trump floating a 100% tariff on semiconductors, possible exemptions for companies manufacturing in the U.S. or at least planning to. Are semiconductor stocks maybe underestimating some of that tariff risk, or is right now we just don't have enough information to really go off of anything?
We're hosting our technology leadership forum, and we've got all the major chip companies here, and all these CEOs and CFOs and executives are really struggling to interpret that, right? It's really unclear what the requirements are to be exempted from those tariffs. Obviously, at a high level, you need to be committed to manufacturing in the U.S. It's unclear if you've got plans to commit to manufacturing at a TSMC in, let's say, Phoenix, qualifies you for that exemption. But it's a little murky right now in terms of what the requirements are to qualify for that exemption.
And we've seen strong earnings from big tech on the back of AI demand. You were just saying how Nvidia is one of your top picks. How does all of that backdrop set the stage for Nvidia results later this month?
Yeah, I think, right now, I think things are actually a little bit more clear, right? There was the China AI chip ban, so Nvidia had to come out and write down all those revenues, and now they're allowed to start shipping again, but you need a license. And then the latest headlines is that there's going to be a 15% tax on these AI chips. I think actually what's really good for Nvidia right now is the Chinese AI revenues is out of the numbers, right? And whatever they ship to China is really going to be kind of incremental upside to the strong results that we already expect from Nvidia at this point in time.
And you just mentioned the government deal that we just got, that they are going to be receiving a share of Nvidia and AMD's China chip sales. How do you expect that to impact not really only Nvidia, but really the broader semiconductor space?
I think people and companies especially are going to have second thoughts about how aggressively they want to ship chips into the China market, especially if they're going to be slapped with a 15% tariffs or tax, right? I think the other thing that is a little bit concerning here is we've seen this kind of policy kind of waffle back and forth, and that's really hard for management teams at these AI chip companies to kind of plan their forecasts. If in one quarter they're banned, next quarter they're allowed, but then again, then there maybe there's some strings attached in terms of the taxes. So I think companies are really going to kind of think twice about how much effort they want to put into kind of in terms of optimizing their China franchise.
And you were just talking about KeyBanc's Tech Leadership Forum. Micron is actually one of the big companies presenting. What's the biggest takeaway you're hearing from executives on the ground this week?
Yeah, a couple things. I think the tariff situation has made it extremely difficult for chip companies to kind of forecast kind of their outlook into the back half of the year. We just got through earnings. They all kind of guided for kind of a largely seasonal, slightly sub-seasonal kind of third quarter outlook. They're all really struggling to kind of guide into the fourth quarter right now, because right now customers really don't want to spend on procurement, spend on any sort of purchases, because we just don't know what the tariff situation is, right? And that's really making it difficult for them to forecast. I think what Micron's results show us is that the AI and the data center market remains extremely robust. The outlook for them going into next year with kind of their outlook for HBM, which is high bandwidth memory, which is used, in AI data centers, is going to be a key driver of growth for that company.
John, thank you so much. Appreciate those insights.
Thanks for having me.
CoreWeave earnings are just hitting the wire and shares are trading lower. We are currently down around 7%. We're seeing shares actually extend some of the losses following these results here. And what we're seeing is that a wider loss than was expected here. Second quarter loss per share of 60 cents. The estimate was 46 cents. Revenue did beat expectations, coming in at 1.21 billion. The estimate was for just shy of 1.1 billion. We also saw operating income fall significantly short of estimates, 19.2 million compared to the expected 43.8 million. Now it's interesting because heading into this report, we did see shares close higher, up around 6% on the back of an upgrade from JP Morgan. But this is a company that, as we've been saying, it's not profitable yet. It's not expected to turn a profit until late 2026. And given this intense run-up that we've seen since its IPO debut, it has been a highly contested stock. It's often sold short. According to S3 Partners, more than a third of the company's shares are sold short. And remember that a quirk here for this company is that CoreWeave has a very high concentration with its customer base. Only a few names that drive the bulk of that revenue, one of those names being Microsoft. And that's fueled a lot of the gains that we've seen over the past few weeks after Microsoft said it plans to ramp up its investments in AI infrastructure. So there's been a lot of momentum for this stock, especially over the past few months. But we're seeing shares down at 7% today, Steph. So your reaction to this report?
I mean, I've said this before, but I'm like, expectations are everything. And the stock, it's giving back everything that it gained today. The stock is up over 250% since it IPO'd. And, you do look at it, like their revenue beat by quite a wide margin, but their earnings per share did not. And that tells you how much they're spending. And so the question comes back into the fold, which is, are you going to get the return out of what you're spending? Mm-hmm. And it looks like they're expanded their deal with OpenAI. I know we didn't get guidance yet, but I do think that will be important.
Yeah, and to that point, there was this concern that maybe investors were getting a little too over their skis when it came to the valuation and pouring a lot of that money in into this name. But we have heard from analysts that this is a company that's really sitting at the center of the AI trade. A lot of secular tailwinds that we could continue to see, especially on the heels of that aggressive AI spending. But we did see a slew of analysts cut their price targets following that news that CoreWeave would acquire data center operator Core Scientific in that all-stock transaction. There were concerns that was going to dilute a lot of the shares that were available on the market. So I'm curious to hear about what they say on the earnings call about that deal and how that maybe impacts guidance.
Yeah, I mean, it's about the spending. Can you get the reward for the risk that you're taking, right? They're expanding on data centers. Every tech company out there is expanding in their data centers. And you just have to be you have to hear what their plan is in terms of making that money back. And I know they also issued debt recently too, so they're definitely all in.
Right, but I mean, JP Morgan, right before these results, raised its price target on shares and did say the company's ongoing AI ramp is intact. So we'll continue to monitor that and see what they say on the call. Again, its shares are down around 8%. Well, Steph, thank you so much for joining for this last hour, jam-packed day. But after the break, we're going to talk about Kava's quarterly results. Stay tuned. Kava, second quarter earnings hitting the wire, and shares are down over 20%. Here to break down what's going on is Yahoo Finance senior reporter Brooke DePalma. So, Brooke, I'm guessing it wasn't a great report here.
Yeah, not a quarter that we definitely want to see here from Kava, that Mediterranean fast casual chain. The company missed on revenue and same-store sales growth, and ultimately that led the company to then cut its full-year forecast when it comes to expected same-store sales growth. Let's dive into a bit of the numbers here, because we did see revenue come in at $280.62 million. That was lower than the $285 roughly million that Wall Street had expected. Earnings did beat. Adjusted earnings came in at 16 cents. That was about 3 cents higher than what the street had expected, but that same store sales miss was definitely a sore note for the quarterly report from Kava. That came in at a 2.1% increase. That's compared to what Wall Street had expected of a more than 6% jump. Now, that growth of 2% was led a bit higher by a mix of menu prices as well as products mix, like guests adding those pita chips to their order. But ultimately what we saw during this past quarter was that foot traffic was flat, according to the company. And the CEO saying this afternoon that tailwinds weren't as strong as maybe they have been in previous years. The CEO there, Brett Schulman, ultimately calling it as well a fluid macroeconomic environment. Now, heading into this report, the company was under a bit of pressure. Year to date, shares are down more than 25%. And as you can see right there, shares still under pressure. Looking at the YF toolbox here, the shares are down more than 20% as well.
And Brooke, how does this compare to what we've heard from some other fast casual chains this earnings season?
Yeah, well, what's interesting is that this is sort of an extension of what we heard from Chipotle earlier this year, rather late last month. They had said that they also were experiencing ongoing volatility in our trends in the consumer environment. That company also cut its guidance. They also missed on revenue, and similar to what we're seeing today is that they reported adjusted earnings that were in line with expectations. And so ultimately what we're seeing here is these players that were really rallying in 2024 get a bit of a pullback here, as that value proposition that they really banked on isn't maybe holding up as well as they had expected.
Hey, Brooke, thank you so much. Appreciate it. Time now for What to Watch Wednesday, August 13th. Starting off on the earnings front, we'll be getting some more reports on Wednesday from Brinker International and Cisco. Cisco announcing results for the fourth quarter after the market close. The company's 2026 forecast will be in focus for investors when it reports Q4 earnings. Analysts expecting strong demand for its AI-related products, which could push sales for the top end of its fourth quarter guidance. The company's 4 to 6% revenue growth target is likely to remain unchanged. And also, taking a look at Brinker, the global restaurant company reporting fourth quarter earnings on Wednesday. Analysts forecasting strong sales growth in Q4, driven by strong performance at its flagship chain Chili's. And moving over to the Federal Reserve, we'll be getting another round of commentary from multiple Fed presidents. On Wednesday, investors will be closely listening for any talk on tariffs. Kansas City Fed President Jeff Schmidt is saying on Tuesday that increased tariffs appear to be having only a limited impact on inflation, but that's reason to keep Fed policy on hold and not to ease. This coming after July's consumer price index came in less than expected on Tuesday amid worries that tariff-induced inflation would show up in the report. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Don't go anywhere. On the other side of this break, it's Asking for a Trend. I've got you covered on the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.